We all want to know, is the bear market over?
Right.
The S&P recently climbed more than 20%. That's from a 2022 low. Here's what that looks like. And we've definitely been on an upswing. So I want to know, how do you define a bull market? I'm seeing some experts who follow that 20% rule, but others consider that to be a false signal. Which metrics are you looking for?
Well, we actually look at this, and some people say, "Oh, the market's up." But if you actually look at that chart that you have there, it's still down from where it was. I guess it just depends on what time frame you're looking at. And the problem with rules like what you just mentioned is that maybe a few stocks are actually pushing everything around, making it look like the market is fine, when in fact maybe it's not as fine as it is, because those couple stocks are making it look really good. What I like to do is I like to look at the overall health, what I call under the hood, where you can see what is actually happening under the hood for all companies, not just a select 2, 3, or 4 that are doing astounding and making it look like everything is great. So for example, one of the things I look at, and I brought here, is I like to look at the S&P 500. There's 500 companies in there, and I like to see as a percentage how many of those 500 companies are actually acting good, how many are actually green and positive, and how many are negative. Because if you think about it, if it doesn't matter how good a couple of things are, if I have 90% of the companies in the red and only a few green, it's going to be a hard thing for that market to do anything. And so that's why this number is important. So for instance, if we look at November of 2022, 25% of the S&P 500 companies were acting in the green. That means 75% were either red or yellow, not positive. And so that's why we were having a lot of fluctuations back then, more volatility. Volatility subsided now, but what we're seeing is now 49%. Up from 25%, 49% now companies on the S&P 500 are operating in the green in positive territory. So that's a definite move in the right direction. It's telling me that everything is getting better from that standpoint, because under the hood, more companies are now positive or green versus where it was in the past.
I'm glad you brought that up, because let's show everybody what that looks like. This is a chart from FinViz, which shows the S&P year to date.
Yeah.
So we do see a lot of green on the board, but this green has been led by just a few companies. It's propelled by artificial intelligence. And then when we talk about the individual stocks in the S&P, they've risen less than 3%. So for those who do believe the bear market's over, do you think they're missing the bigger picture?
Well, like you're seeing here, NVIDIA, Meta, which is Facebook, Apple, Microsoft, Google, it's these names that are pushing everything around. Oddly enough, tech was the place that got the biggest hit in 2022. Now it's going the other way. And because of just a few stocks, I mean, it's really crazy to see just those few stocks is making the S&P and all these other indexes look good, because they make up such a big portion of the S&P 500 or the NASDAQ. But we've been feeling, I think, this bear market since 2022. It's pretty much I think it really started November of 2021. So if you think about all that till now, this has been a very long bear market that we felt. And so the signals are starting to turn green, which is a good thing. We're starting to see the S&P turn green. We're starting to see the NASDAQ and the Russell 2000, that's 2,000 small cap companies, starting to turn the corner too. We still haven't seen the Dow. The Dow is still lagging a little bit. But what I tell people, as far as your question goes on, on missing the bigger picture is we still have inflation that's still not in control. The Fed is still dealing with it. The Fed is still saying that they're going to hike up interest rates 2 more times. And we've seen what happens when the Fed hikes up interest rates. It causes bond prices to go down. It causes the stock market to get worried. The Fed is trying to get unemployment to go up. They haven't been successful yet. And so that's a concern. That's why a couple of days ago, when the unemployment numbers went down, the stock market sold off, because the stock market looked at that like, oh, well, unemployment's going down. And so that must mean that the Fed is going to hike up interest rates even more to calm unemployment. We still got mortgage rates that are still high. So there's all these headwinds and that would affect the stock and bond market. So I don't think we're out of the woods yet. Yeah. Although we're in a much better place now than we were a year ago.
Yeah, lots of moving parts. Hedge funds and many other investors made big bets on the S&P falling. There's still a lot of cash sitting on the sidelines right now. Do you think a defensive position still makes sense?
Well, it makes sense less now than this time last year. Even we've made some adjustments to take advantage of this recent market rise. But consider this, things are still very volatile. Things will still be volatile while the Fed is still hiking up interest rates. And so we've got to be able to adapt and adjust if the market goes the other way. So don't just say, oh, everything is great. No, we need to worry. Everything is calm and clear. That could be short term, because if we ended up heading into a recession later on this year, there could be some issues to deal with, some uncertainty to deal with. So being able to be defensive, maybe not as much now as it was last year, but being able to be defensive again quickly if all this turns bad again is definitely key.
So you just mentioned the R word, Nick. I know it's hard to predict, but do you think we're going to see a recession this year?
So we really didn't think that we were going to see one at the early part of 2023. We thought it would happen more towards the tail end of 2023, maybe into 2024. And so we're getting there now. And why? Well, because all the stuff that the Fed does takes time. People think, well, when the Fed does things, it's going to have an immediate effect. No, it really doesn't. It takes a while for hikes up in interest rates to affect things. So eventually we could see unemployment go up. We're already starting to see companies doing layoffs more now than they were, that we're starting to hear it. Well, it didn't happen then, but now it's starting to happen. Real estate could get hit as a result. Then we have things, when you think about the Fed's actions, when they try and slow down recession, or when they're trying to slow the economy down, they actually put us into recession. So I'm just saying all this stuff that they're doing takes time to get through. And so we want to be ready. I wouldn't put it off the table. I would just say it might be towards the tail end of 2023 and maybe into 2024 before it actually happens.
Well, we will certainly talk then, Nick, because I think it's always fun to talk through the headlines with you. If somebody's feeling anxious, though, about any of these headlines or where the markets are going or whether they're appropriately positioned, what's the best way to reach you?
You ultimately just have to have a plan. And doing that means you've got to stress test where you're at. You got to look at your baseline. Here's where I'm at. And if we go into a recession, how is that going to affect my money? And the good news is, with technology, we can help people figure out if they're positioned right to be able to withstand not just a good market, but also a sour market. And so easiest way is to get a stress test done on that money. And that's something that we can do for people, or at least coach them through how they stand. And the easiest way is just give us a call at 844-GROUP-10, or you can go to our website, group10financial.com, and on there you can schedule a 15-minute strategy session to really talk through stress testing and being able to be recession ready.
So helpful. All right, Nick, thank you.
Great being with you.